Today's top three things. Number one, the U.S. dollar. Number two, oil. And number three, the 10-year bond yield. I'm going to talk about 10-year bond yields more globally this morning, but I will focus on the U.S. in as much as anything else. First thing on the dollar. So yesterday we got a higher high both on a year-to-date basis and on really a 6 to 9 month basis, since the dollar has been putting on what has been nothing short of a deflationary move for commodities. Yesterday was an epic move to the upside for the U.S. dollar, really finally hitting its higher highs. So again, you hit the higher high, commodities were down on the day. CRB index, which is a broad measure of commodities, were actually down on the day on the order of 0.9% or down 3.4% for the year to date. So again, get the dollar right, you get the deflation right. And if you have your deflation set up properly, again, you are long consumer discretionary, which is one of our favorite sectors. It was up 1.2% on the day in XLY terms. And XLE, energy stocks, continue to suck wind. So again, you don't want to be long the inflation, you want to be long the deflation. The recipient of the deflation remains the consumer, whereas the enemy of deflation remains the debtor and the commodity holder. So that's point number one. Point number two is obviously these things get overbought and oversold. But again, if you look at what that actually meant to the oil price, again, a lot of people are trying to debate where oil goes from here. My best estimate for where oil goes from here is what it just did. Again, what it just did. Anyone who's trying to give you some fanciful expectation of $60, $70, $80 oil because that's what they need, I think you should check their premise. I think you should check their conflict of interest. There are a lot of energy companies who need $80, $90, $100 oil. So again, don't forget that that is what it is. What we do every day is we look at price, volume, and volatility on a three-factor model, and we look at that price deck. And currently on the immediate term price deck, I can tell you that it is 48.04 on the downside and 52.23 on the upside. On the intermediate term, let's call it 3 months or more, I can get you to, I think, 56 and change on WTI. And again, I'm talking about WTI. I can't get you to 60. I cannot get you to 70. I cannot get you to 100. So again, if you have a price deck that is implying those levels, Hedgeye Risk Management disagrees with you wholeheartedly this morning on that. Finally, 10-year bond yield, just to hit on it again, it's been hit to the upside, downside, all back and forth again. Last week, just to review, the context of the move is always critical. Bond yields, obviously, on the 10-year across the world are down for the year to date. But last week on the 10-year in the U.S., you were down 12 basis points on the week. You've actually recovered almost all of that as of this morning. So again, all this only matters from very short-term trading perspectives. What really matters is the jobs report. So the jobs report, we think, if it's bad, bond yields can go to 1.84%. If the jobs report is good, we can get you to 2.16, 2.19%. That's the upside and downside. There is no politics. There is no view. There is no guess on the jobs report. It is purely a scenario analysis. And again, it hinges largely on the Fed's last of the lagging indicators, which is an expectation that the jobs market will never deteriorate. Underneath the hood, FYI, it's already deteriorating. So those are your top three things this morning.